This is our Forex blog for April 16th, 2013, and I'm going to show you one of the best and easiest ways of trading. These are our currency indexes, which don't exist in the wild. I actually create these charts myself of each individual currency. This is the dollar index, the yen index, pound index, euro index, Swiss index, Australian index, and so forth. And it lets you see a wealth of information. First of all, it lets you see the trend. The dollar's going down. It's underneath its hourly moving average. Here's the previous day's high. The yellow line is yesterday's average price. The traders have most positions here. The orange line is last week's most traded price. And typically above that, it's going to go up. Below that, it's going to go down. And in between the hourly moving average and this level, it tends to be choppy, which you can see. You also can see the daily and weekly trend underneath it. Now, in the past, for the last 6-7 years, we've focused on having currency meters, which basically show in histogram format what's going on with the trend. But it's much easier to see an actual chart. So let's mark up some of the trades you could have taken on this. First of all, the daily and weekly trend of the dollar started out today up. The monthly trend's down. But once it's underneath the hourly, you're looking for sells, and especially when you see incredible intensity like that. So here's a decent place to sell. Go sideways here for an hour and a half. That's a pretty decent place to sell. I would look to probably sell there, and I would have lost on that one. Look to sell here. That one worked. Look to sell here. That one worked. If you missed that trade here, you could also sell the breakdown to the new lows. And anytime a currency makes higher highs or lower lows, like in this case, usually the first pullback's a pretty safe place. So again, the places that I think are the highest probability selling are there, there. This one failed. This one. You could have also tried that one. It probably would have been a break-even trade right here, here, and here. And basically you want to, because the dollar is weak, especially when it breaks down underneath the hourly, you want to sell the dollar versus whatever currencies are strongest. Let's take a look at the euro. For one, it's in a nice, beautiful sideways rectangle pattern right here. It's above the hourly. It's above last week's most actively traded price. This is market profile technology. It's called the point of control. This is where most traders have positions in all the euro pairs. Remember, this is a euro index. We look at the euro dollar, euro yen, euro Swiss, euro CAD, euro pound, euro Australian, and euro New Zealand and create these charts. And it's absolutely wonderful to trade because you can spot pullbacks, you can draw trend lines, wait for a pullback, you get long right here, you get long right here, you get long, either right there or here, you get long, maybe right here and you had a loss, you get long right here and another big win. So let's take a look at times where the euro is likely to go up and the dollar is likely to go down. You can clearly see the dollar's going down when the euro is likely to go up. Dollar's going down when the euro is likely to go up. Right here. Now, if the dollar goes sideways and the euro goes up, typically I've found you're going to make 10 to 20 pips typically on an intraday trade for 15 minutes to half an hour. If the euro goes up while the dollar goes down, you're going to make 20 to 50 pips and sometimes up to 100. So you don't, if the euro is going up and you see the dollar just kind of floating around sideways, you're still going to usually make money on the trade. Not always, but most of the time. And so if you look, some of these other times, this one right here, you can see the dollar fell, but the euro went sideways. Even so, at 130 right here, more than likely you made money buying the euro dollar. So let's take a look at those charts of the euro dollar chart. And every time I take the drawing tool off, it disappears. But let's focus on this one right here at 6. The euro went up, had a lot of intensity, pulled back with almost no weakness. Statistically, the euro is not very weak right there. You're looking for buys. You're also looking for sells in the dollar. So it's a perfect one to buy the euro dollar at 6. Let's make this chart here bigger so we can see it. Whoops. Six o'clock is right here. You have the pullback. And typically, this is just a 5-minute chart, but I would suggest using a range chart, 4, 5, or 6 pips per bar, or a tick chart, anywhere from 30 to 60 ticks per bar. It allows you to get into trades with less risk typically 4 to 6 pips. With a 5-minute chart, you might be risking 6 to 12 pips. But as soon as the trend line gets broken, you get in, you put your stop underneath the low, and you can see typically these upper containment bands are when the market's going to kind of run out of steam. And so you risked this much, and even if you got out of the trade right here and you missed this next move up, this is how much you made. Now let's go back and look at the chart at 10 o'clock right here after this decent pullback. At 10 o'clock, you can see the euro was making a nice pullback right there. 10 o'clock is right here. That the dollar is real close to major resistance selling at the hourly moving average. So it's a very high probability place to trade. Notice the euro also at 6:30 went above yesterday's euro index high. So at 6:30, the euro is stronger today across all the pairs than it was yesterday. So it's a very significant event. If all you did was waited and bought a currency when it broke out above the previous day's high, right here at 6:30, and the dollar's weak, so you buy the euro dollar at 6:30. At 6:30, you can clearly see the yen is going down. It's underneath the hourly moving average. If you bought the euro dollar or euro yen at 6:30, if all you did was wait for breakouts and you took those trades, you know, occasionally you're going to have false ones like this where you might lose 6 to 10 pips, but the times that you make money are typically going to be, you know, 30 to 50 pip winners. And you're going to be right, in my opinion, more than half the time. But let's take a look at that 10 o'clock trade. You notice on the chart that the euro was likely to go up, or at sideways minimum, and the dollar is definitely likely to go down. And so you were aware of that ahead of time. That's how you anticipate future trades. And when you have a currency that's trending up as strong as this, another method you can use for buying and for anticipation is just simply wait for, on the perfect oscillator, a pullback to the lower containment band, or even preferably to the lower extreme, like right here and here. So this trade right here went up a little bit. This trade right here, you know, you would have lost on because the market kind of went sideways and chopped down. But once you have a trend that's up, notice right here, ideal place to get in, right here. I don't like to buy above the 2.0 white upper containment band. It's pretty risky. That being said, I do it, but I am always afraid of doing it because, you know, half the time you're going to lose when it's above the upper containment band. But if you do take that trade, you just simply draw your fibs off the last wave and typically get out at the 1.382 fib target. But again, the lower containment band, this one right here would have been a little loss, and you got in a little bit later and got it back. Right here, ideal place to get in. Right here, also a great place to get in. So let's take a look at the fib target of that last move. You know, if you bought that breakout right here, well, you draw your fibs on that last little spot, and guess what? It went right to the 1.382. Now, if you're an aggressive counter trend trader, if you see an extreme in the perfect oscillator, it's above or upper bands, and it's at a fib target, you know, take a shot at it because you can clearly see it fell like 40 pips. Now, this is where you want to use a tick chart or a range chart, especially for doing counter trend trades, because there's increased risk and a lower odds of the trade working with. And I would even drop down, instead of using a 5 pips per bar, maybe 4 when you're going to do counter trend, or when you're going to take additional risk of doing a counter trend trade. It just makes sense to me. Let's take a look at that. Where was that exact time when that got hit? It was 8:30. So let's scroll back and see it. So the previous fib area from here to here. So you might have actually gone short right here. Came down, went sideways, you get out with a very small win. Comes up again, you go short. And typically I will kind of just draw a trend line over the highs. And, you know, sometimes it falls the rest of the day and you'll be in an absolutely huge win, and other times, you know, it starts to go back up again. But you would have been short somewhere at 40, out of this trade at 21. That's not bad. I probably would have shorted again right here and lost. Shorted again somewhere up in here and wrote it down a little bit more, as you can see. But the euro was incredibly strong, and the dollar was weak, and the yen was weak too. Remember, when the euro broke out here at 6:30, by all means, if you want to buy the euro yen at 630, you're probably going to make 30 to 50 pips. Here's 630. Notice 128, 128.10. Where'd it go? 128.90. So 80 pip move. And notice the hourly moving average. Above the hourly, it tends to go up. And again, you can look for perfect oscillator minus 80 levels to get in. Right here. This one here failed. So when it fails, you lose this much. When it wins, you typically make many multiples of that. And anytime it goes up and hits the lower band, it's not a bad place to get in. But again, it's above average risk, above the upper white band. So let's take a look at some pairs other than the euro. And I'm going to, because these charts all have the same color on here, I'm going to scroll back and we'll look at a different time of the day. I mean, there's so many different patterns you can use on this. Here in the Australian, you can see the daily and weekly trends down. You have a nice little trend line here. You have what's appears to be a wedge pattern where volatility is high and then gets smaller and it gets smaller and it gets smaller. What a great place to sell right here. And you'd want to sell the Australian against whatever's strongest at 10. Well, at 10, remember the euro is one of the strongest and had a beautiful pullback. So buying the euro, I'm sorry, that's the Swiss right there. Buying the euro Australian or selling the Australian Swiss makes incredible sense at 10. So these are all anticipatory trades. Here's the euro Australian at 10 o'clock. And guess what? Here's 10. You have this beautiful pullback, 2650 or so. When you get in, it goes up to 2700. It's a 50 pip win while risking this tiny amount. And you pretty much, when it gets above the upper containment band, when this hits the plus 80 level, it's usually going to reverse. And if you drew your fibs off this previous wave, you know, we all know the fib targets are up here. Probably perfectly hit those areas, I would bet. So let's draw them on here to see. So you can see, look, to the pip, 1.382. It's above our statistical likely reversal area right at this level. And you also have a totally different indicator, which I call the perfect oscillator, because you know it typically is, especially when it's outside the band, you're going to get a reversal. And again, when you see a strong currency like this and it pulls back to the oversold area right here, pretty decent place to get in, even though it only went up about 15 pips. This area right here, very close to it, underneath the Bollinger Band on that tool, not a bad place to get in. It's also a 38% fib pullback. So that's the Euro Australian. Let's take a look at the Australian Swiss. The Swiss was strong too. The Australian was weak. Let's take a look at this, especially at 10 o'clock. 10 o'clock right here, or you know, somewhere towards 10 o'clock. This one was trending down. It made a pullback up to the hourly, which is oftentimes a resistance area. You got your trend line underneath the bars low, and you go short right here. You're risking this, and this is how much you made. You're never going to catch every pip. Obviously, this last probably 10 or 15 pips you might have missed. And when you see an extreme like this, you got to watch it like hawk, because it's more likely to go up than down. And anytime you see a currency make a lower low, typically the first pullback is another good trade. This one also happened to hit the upper Bollinger Band of the perfect oscillator, and so you know this is your place that you're looking to get in. Maybe you got short right here and you lost 5 pips, and then you got short again right here when it broke those bars low, and guess what? You got your loss back plus another 15 pips. And that's the key to secret to trading. Small losses, big wins. And look at this, plus 80 level, big strong trend down. It's gone up too much for this time of the day. That's what the perfect oscillator tells you. Look at that, short right there, or wait for the bar low to get broken. You know, you're never going to catch every pip, but that's how much you made while risking this super tiny amount. So you made 2.5 times on that very low risk trade. And that's the secret to trading. That's why our software works for people that trade it the way I teach it. If you do some other weird stuff with it, it might not work for you. If you trade this way, especially using the currency indexes, you're not afraid to trade whatever pair is the most likely to go up or down. You should do very well.